Brian, three of the most common investment choices, safe investment choices: money markets, CDs, and fixed annuities. Let's talk about each of those individually.
Yeah, it's not the most exciting topic we're going to cover here, but there are, as I've mentioned, there are five big asset classes that you can invest in. Bonds is one, equities, real estate, insurance company products, and finally cash and cash equivalents. So thought I'd spend a little bit of time on one of the big five, that's cash and cash equivalents. And we all need this as part of our portfolio. You need to have some liquidity that's not in the market for many reasons. So if you've decided you have cash but you want to make some money on it, the first thing most people think about is a money market. At least historically they have. The problem with money markets, though, is they don't pay hardly anything anymore. You think savings account, money market, that kind of thing. It used to be a standard place to go. I remember back in the mid-2000s, if you had uninvested cash in the money market, the custodian, you regularly got between 5 and 6%. So let's say you were getting 6% on uninvested cash and you had $2 million. You could safely put $10,000 a month into your account, live off the interest, and have a great life. Well, that same $2 million today might be, $1.98 in interest. So it's just not the same world. So money markets definitely have changed over time. CDs, of course, used to pay really nice rates. I remember when I was picking berries growing up, I remember seeing CD rates over 12%. Well, my savings account was over 12% when inflation was high. And so CDs would pay even more than that. But of course not anymore, and now you're lucky to get 1% maybe, depending on the CD. And finally, fixed annuities is another safe area. It pays generally much more than money markets or CDs. However, with a fixed annuity and with most CDs, you're tying your money up for a period of time. So their liquidity isn't as good in exchange for a better rate of return.
So, Brian, as you said, money markets don't necessarily return much on your investment. Why would you want to use a money market considering what we know?
Well, sometimes the best investment is no investment. Markets are going down. You don't know what to do with your money. You don't want to tie up your money. You need liquidity. You want liquidity in case something comes along. You're ready to go after it, and maybe it's tied up in something you can't get to in time. Peace of mind. There are a ton of reasons why having liquid cash can make a lot of sense for someone. Everybody should have some reserves in liquid cash, so that can be a very good place. With CDs, you got to tie it up for a period of time. Typically, it might be 3 months, it might be 5 years. Fixed annuities, same thing. You're going to tie it up for a period of time. So certainly money markets and just cash on hand. It is not a crime to not invest your money. Don't invest your money, I would say, unless you know what you want to get into and you know you're not going to need it before you can get to it.
So the biggest factor, I think, here is going to be liquidity. Money markets, very liquid. CDs, not so much. And then fixed index annuities, not as much either. Between all of those, I mean, is there one that may have more of a potential of the upside?
Well, the fixed annuity would pay the most. Fixed index annuities pay even more in good years, and that's outside of this conversation. But with the cash and cash equivalents, you might know that you'll need different amounts of money at different times in the future. So you have a certain amount in cash and money market. Maybe you won't need money for 6 months to pay your taxes, and you'll put that into a CD and get a little bit more interest. And maybe you'll need some money, but it's 3 years from now, so you might buy a fixed annuity for that. That's a 3-year time period. So depending on if you know when you're going to need the money, you can maybe eke out a little bit more interest. But there isn't a huge difference between them right now and in the times that we're in. Historically, there has been, though.
Brian, what would have to happen for times to return the way that they were where these instruments were paying more?
Well, unfortunately, inflation and interest rates going up across the board, that has its own problems. Even though you can get a really good rate on a savings account, when I was picking berries way back when, we had oil embargoes and we had stagflation. We had a seriously bad economy at the time, and that's why the rates were so high.
Brian, thanks for telling us more about money market CDs and fixed annuities.